Well, ladies and gentlemen, welcome back to Boss Economics World, the only show that takes the dismal science of economics and turns it into a full-blown tragicomedy. Today, we're diving headfirst into the chaotic, gilt-edged mess that is the Bank of England's bond portfolio. Oh yes, folks, it's time to talk about quantitative tightening, or as I like to call it, quantitative tantrum, and the £163 billion question, should the BOE just cling to its long-dated gilts like a toddler with a security blanket, or risk setting the entire UK bond market on fire? Spoiler alert, it's already smoldering. Now, for those of you who've been living under a rock, or, let's be honest, just trying to survive the cost of living crisis, here's the deal. The Bank of England, in all its infinite wisdom, spent over a decade gorging on UK government bonds, or gilts, during its quantitative easing, QE, binge. Picture this, post-financial crisis, Brexit, the pandemic, every time the economy sneezed, the BOE whipped out its magic money printer and bought up gilts like they were going out of style. At its peak, the BOE's balance sheet ballooned to nearly £900 billion. That's right, folks, £900 billion, with a B. But now, the party's over, and the BOE is trying to sober up through quantitative tightening, QT. And let me tell you, this hangover is uglier than a hedge fund manager's tax return. So, what's the big deal? Well, the BOE is sitting on £163 billion of long-dated gilts, those are bonds with over 20 years until maturity. And here's the kicker, nobody wants them. I mean, sure, back in the good old days, pension funds were snapping up these bad boys like hotcakes, locking in steady returns to pay for your nan's retirement. But now, pension funds are stepping back, and the market is being overrun by flighty hedge funds and foreign investors who'll drop gilts faster than you can say, Liz Truss. And if you thought the market was stable, think again. Just this month, July 2025, rumors swirled that Chancellor Rachel Reeves was about to get the boot, and what happened? A massive sell-off of 30-year gilts. Yields spiked, prices tanked, and the market went into full-blown meltdown mode. Sound familiar? It should. This is basically a rerun of the 2022 Liz Truss debacle, when her unfunded tax cut sent long-dated gilts into a death spiral, forcing the BOE to step in and save the day. Ah, memories. But here's where it gets juicy. Some brainy economists, like Michael Saunders, former BOE rate setter and current senior advisor at Oxford Economics, are saying, hey, maybe the BOE should just stop selling these long-dated gilts altogether. That's right, folks, just hold on to £163 billion of bonds, potentially for decades, and pretend the problem doesn't exist. Why? Because every time the BOE tries to sell, it risks destabilizing the market even more. And let's not forget, the BOE isn't the only one trying to offload debt, the UK government is borrowing like there's no tomorrow, competing for the same buyers. It's like trying to sell ice cream in a blizzard. Now, let's break this down, boss economic style, and peel back the layers of this economic onion. Warning, it might make you cry. At the heart of this mess are three big, juicy economic issues: market stability, fiscal sustainability, and the shifting sands of investor behavior. Buckle up, folks, because we're about to go from point to surface faster than a hedge fund dumping gilts. First up, market stability, or the lack thereof. The BOE's quantitative tightening program is supposed to shrink its balance sheet by £100 billion a year. Sounds simple, right? Wrong. This year, they plan to do it through £13 billion of active sales and letting £87 billion of maturing debt just roll off. But here's the problem, next year, there's less debt maturing, so if they want to keep up the £100 billion pace, they'll have to sell even more gilts. And guess what? The market's already throwing a tantrum. Take a look at this beauty. According to Bloomberg data, yields on 30-year gilts spiked to 4.8% in July 2025 during the Reeves rumor meltdown, that's the highest since the 2022 Truss crisis. And it's not just a one-off. The BOE's own surveys show investors expect QT to slow down by £25 billion, implying just £26 billion of active sales. Why? Because the market's liquidity is drying up, especially at the long end of the yield curve. BOE Governor Andrew Bailey even admitted it, saying there's been a change in the liquidity of the curve at the long end. Translation, the market's a mess, and the BOE's QT is pouring fuel on the fire. And here's the kicker, the BOE's not alone in this mess. Look across the pond to the US, where the Federal Reserve is also tightening. But here's the difference, the Fed's balance sheet is mostly short and medium-term bonds, so they can just let them mature without rocking the boat. The BOE? Oh no, they went all in on long-dated gilts during QE, so now they're stuck actively selling into a market that's already screaming, no more. It's like trying to sell a haunted house in a buyer's market, good luck. Next up, fiscal sustainability, or as I like to call it, the Treasury's black hole of despair. See, QT isn't just a market problem, it's a fiscal nightmare. Every time the BOE sells a bond at a loss, guess who picks up the tab? That's right, the UK taxpayer. According to the Office for Budget Responsibility, OBR, QT is costing the Treasury tens of billions of pounds in interest rate and valuation losses. In 2024 alone, the OBR estimated losses of £20 billion, and with yields rising in 2025, those losses are only getting worse. And it gets better, or worse, depending on your perspective. Michael Saunders' big idea is to hold on to £163 billion of long-dated gilts forever, writing down £120 billion of them to their nominal issue price. That would crystallize a £27 billion loss up front, adding it to the government's debt pile. But here's the silver lining, folks. Saunders says it'll be profitable in the long run because the BOE can hold these bonds against its currency liabilities, like notes and coins in circulation, which are cost-free. The average coupon yield on these gilts is 2.7%, so the BOE could make a tidy profit. Sounds great, right? Except for the part where the government's debt jumps by £27 billion overnight. And let's not forget the political pressure. With the UK's debt-to-GDP ratio already at 100% in 2025, up from 85% pre-pandemic, according to IMF data, the Treasury is desperate to get this debt off the BOE's books. But here's the catch: if the BOE slows down QT to avoid market chaos, the losses just keep piling up. It's a classic catch-22, folks: destabilize the market or bankrupt the Treasury. Decisions, decisions. And finally, let's talk about the real villains of this story: investors. Back in the day, the gilt market was a snooze fest, dominated by boring, predictable buyers like defined benefit pension funds. But now? Oh no, the pension funds are stepping back, thanks to rising interest rates and changes in liability-driven investment, LDI, strategies. According to the Pensions and Lifetime Savings Association, UK defined benefit pension fund demand for gilts has dropped by 15% since 2022. So, who's filling the void? Hedge funds and foreign investors, aka the flightiest buyers in town. Take foreign investors, for example. According to the UK Debt Management Office, foreign ownership of gilts has fallen from 30% in 2015 to 25% in 2025, as global investors get spooked by Brexit, political instability, and now the Reeves rumor chaos. And hedge funds? Oh, they're loving the volatility, buying low, selling high, and making a killing while the rest of us watch the market burn. It's like handing the keys to a Ferrari to a teenager. Sure, it's fast, but it's also a crash waiting to happen. So, what's the takeaway, folks? The Bank of England is stuck between a rock and a hard place, or should I say, a gilt and a hard place. If they keep selling long-dated gilts, they risk sparking another market meltdown, a la Liz Truss 2022. If they stop selling, they saddle the Treasury with billions in losses and add to the UK's already ballooning debt pile. And all the while, the market's being overrun by flighty investors who couldn't care less about stability. But here's the real question, boss economics fans: is this just a UK problem, or a global warning? Because let's not kid ourselves, central banks around the world are grappling with the same QT conundrum. The European Central Bank, the Bank of Japan, even the Fed, they're all trying to unwind years of QE without crashing their economies. And with global debt levels at a record $315 trillion in 2025, according to the Institute of International Finance, the stakes couldn't be higher. One wrong move, and we could be looking at a global bond market crisis that makes 2022 look like a walk in the park. Now, you might be thinking, boss economics, what's the solution? Well, folks, if I had a magic wand, I'd wave it and make all this debt disappear. But here's the harsh reality: there is no easy fix. The BOE could take Saunders' advice and hold on to its long-dated gilts, but that just kicks the can down the road, and adds £27 billion to the debt pile. Or they could keep selling, but risk another market meltdown. Either way, the UK taxpayer loses, and the market stays on edge. But here's my advice, folks: keep your eyes on the BOE's next moves. Their August 7, 2025, meeting is going to be a blockbuster, and their September decision on QT will set the tone for the rest of the year. And if you're an investor, buckle up, because this gilt-edged roller coaster is just getting started. That's all for today, folks. Tune in next time to Boss Economics World, where we'll be tackling the latest economic absurdities with our signature blend of satire and sanity. Until then, keep your wallets close and your central bankers closer.